Thanks very much, Tim, and thanks for everyone for coming today. It's good to see a lot of friendly faces in the crowd, and we appreciate you coming in through the bad traffic this morning. This is, as Tim mentioned, the third installment of this type of work that we've been doing on an annual basis in conjunction with Ipsos. And the whole goal of that is to provide a little bit more value-added information on transactions as they go through TREB's MLS system. So, I mean, there's a lot of questions that we can answer when we go out to the public and ask them, number one, what sort of drove your buying decision over the past few years, and number two, what's driving your decision to buy or not to buy in the coming year as we move through 2018. And so maybe just at the outset of our presentation today, I'll turn it over to Sean, and he can give you a sense as to how they undertook the first survey we'll talk about today, which is the Homeowner Survey, which both looks at the broad swath of ownership households in the Greater Toronto Area, but also people who purchased over the last 12 months.
Great. Well, thank you so much, Jason. So the first survey, we did two surveys, and the first one is, as Jason mentioned, among home owners, and we surveyed, I'm just trying to advance the slide here, I'm not getting a lot of success. Maybe Jason's works better. Oh, there you go. Okay, there we go. I'll just point to you and you do it, and this will look fancy. We surveyed 2,500 homeowners in the GTA between the 416 and the 905, including 1,000 recent buyers. And this survey was in field in November, so towards the end of the year. It gives us a good sense of what happened in 2017. And just like any poll, it has a credibility interval or margin of error credibility interval. For the overall results of homeowners, it's plus or minus 2.2 percentage points within the GTA, and among those recent homeowners, it's closer to 3.5 percentage points. Jason, there we go. The first thing that I want to say is when we survey homeowners, I'm going to put this down so that I don't even try to use it maybe. The first thing is most people who own a home live in it. Right? That makes sense. So among the homeowners that we surveyed, just 2% say that they have an investment property and rent it out. And 0%, it's probably 0.3 or something like that, but it gets rounded down to 0, say that they have a home solely for a vacant investment purpose. So among those people who didn't move in the last year, this isn't working very well. There we go.
I got you.
Thanks, good man. The reason why they haven't moved in the last year is to say, well, they like their home. Okay, well, that makes sense. But there are some other reasons why people choose not to move. And if you look further down the chart, some of them have to do with policy decisions. So 5% of people who own a home but didn't move homes or change homes in the last year say they don't like the upfront costs associated with the land transfer taxes, and that was one of the reasons for not moving. And another 5% say it was recent changes made by the government, including more stringent mortgage qualification rules, and that's the reason why they haven't moved in the last year. But for most people, it's because they simply like where they live. If we look at the recent home buying activity in the last year among those who say that they have moved, 71% of them said that they used a realtor in that transaction, and that's down 4 points from where it was last year, but rest assured to all the realtors in the room, I'm going to show you a slide later that shows some upward momentum when it comes to intentions to use a realtor in the next year. Over to Jason to give you some fast facts.
What we'll do is that was just sort of a highlight look at some of the results from that survey, and I'm going to throw it back to Sean in a few minutes once we go through some of the headline figures that came from TREB's MLS system over the past year. But I wanted to start off because Tim mentioned it in his introduction that the impact that GTA realtors have in conjunction with the transactions that they undertake each year is immense. And we asked Altus to undertake an economic impact study for us that looked at transactions conducted by GTA realtors each year. And what we found is that when you look at the annual spin-off expenditures from each one of those transactions on average, you're talking about close to $70,000 additional dollars that percolate through the economy in the form of spin-off expenditures, whether you're talking about moving costs, whether you're talking about monies paid to different levels of government, whether you're talking about renovation expenditure or what have you. And so the spin-off numbers are large, and obviously when we're talking in the neighborhood of 90 to 100,000 transactions on an annual basis, we're talking about billions of dollars each year. And so when we're thinking about policy decisions that impact the demand or supply of real estate in the Greater Toronto Area, obviously there's implications there if we're making decisions that could see fewer transactions from one year to the next, or more, of course, as well. And just sort of leading from that sort of basic spin-off, when we're talking about government revenues. So as we know, through things like land transfer taxes, both at the local and the provincial level, there's a direct relationship between the amount of money that's going into the government coffers each year and real estate transactions in the region as well. So again, we're talking about $2.9 billion on average each year, but obviously this can be affected one way or the other depending on how people's decisions are influenced. And obviously one of the influencing factors over the last couple of years, and certainly as we move through 2018 as well, will be decisions at the policy level, federally, provincially, and potentially locally as well. And jobs are affected as well. So when we talk about sales being up or sales being down, those transactions and those spin-off expenditures, $68,000 to $70,000 for each TREB MLS transaction, that adds up to $142,000 plus when we're talking about the number of jobs in the GTA that are at least somewhat associated with the real estate sector. So these are important things to consider when we're looking at A, what the market conditions are, and B, how those can be affected. So let's sort of jump right in and take a look at what we saw last year in 2017 in terms of sales through TREB's MLS system. And it was a little bit more than 92,000 transactions, and that certainly was a dip in relation to what we saw both in 2015 and 2016 when we saw 2 consecutive record years in terms of transactions. The 92,000 was certainly a high number from an historical perspective. We're at the 5th best level of sales in history, but certainly suffice to say that issues did come into play that affected our marketplace. And not the least of which was the introduction of the Fair Housing Plan in April. I mean, we saw very strong price growth through the end of 2016 and through the first quarter of 2017. I'll talk more about that in a little bit. But we saw year-over-year growth, whether we're talking about the average selling price or the MLS Home Price Index, peak above 30%. And I certainly believe that was sort of the final trigger that saw provincial policy come online that affected the housing market. And sort of the headline or Cadillac feature of that policy was the 15% tax on foreign buyers. But I would argue, and this is based on some additional research that Sean's firm had undertaken for us in 2016, that really the impact of that 15% foreign buyers tax that we saw was more psychological than it was actually sort of pulling sales out of the marketplace. Because what we did is that when we started getting questions about the amount of foreign buying activity in the GTA, we didn't really know right off the top, and no one knew for that matter, including various levels of government, actually how much foreign buying activity there was in the region. So we set about finding out. And so from our perspective, obviously, we had access at the board to 50,000 plus members who are undertaking transactions, who are listing properties on an annual basis. And so we asked them through Sean, if you undertook a transaction on behalf of a buyer over the last year, how many of these buyers were foreign buyers, and then if they were foreign buyers, sort of what were some of the characteristics of that deal. But the headline number was 4.9%. So that's what we found when looking back, that it was 4.9% of transactions undertaken by realtors, basically in 2016 and part of 2015, involved foreign buyers. And initially, when we released this information publicly, it was somewhat panned. It was suggested that it could be biased based on the fact that we were asking our membership realtors about that question. But as we move forward, certainly with the Fair Housing Plan, the government was able to release some information on early sales following the announcement of the Fair Housing Plan. We saw that number was 6.2%. And so that was in line with sort of the confidence interval around those Ipsos results. And later we've also seen statistics released by Statistics Canada as well. And these were in line with additional research that Treb undertook with MPAC statistics later on in 2017 as well, that suggested that, the foreign ownership within the region was in the neighborhood of, say, 3.5%. So the bottom line...
I love this slide. It was because, as you suggest, when the results came out, people said, wow, that looks really low at 4.9%. Maybe realtors were lowballing you in the survey, and it looks like we were sort of vindicated as two other surveys essentially found the same thing that we did.
Right, but I think it's important to point out, though, that while there was about 5% in terms of actual buying activity, I think the impact of the release of that plan, or the announcement of that plan, had a larger overall impact on the market, albeit temporary, with a fairly steep drop-off in sales after, say, the April-May period, to the point where we are talking about now on an annualized basis sales dropping to they say the 70,000 range as we reach the summer months. Now I'm going to talk a little bit more about what we saw sort of in the late summer and early fall as we move through the outlook. So I'll revisit this slide later in the presentation. But at the same time, we also did see an uptick in listings. So this time last year, when we were discussing the impacts on the marketplace, we were talking about months of inventory in the marketplace, not in terms of months, but in terms of weeks or days. And part of the reason was active listings were at record lows. And so as we saw the strong price growth at the beginning of the last year, as we saw new government policy come online from the province, we did see an uptick in listing activity as well, with people thinking that they'd be able to take advantage of the price gains that they had taken advantage of over the previous couple of years. And so we saw active listings tick up, albeit they ticked up to a normal range. We didn't see a scenario where they spiked to the point where we'd say we had a glut of inventory in the marketplace. We really saw inventory move back to more of a balanced state. So from the perspective of pricing, obviously it's a function of demand and supply. So we talked about what happened with sales, we've talked about what happened with listings. If we look at 2017 as a whole, we actually saw a relatively substantial increase in the average selling price on a calendar year basis. But just looking at price on a calendar year basis sort of covers up what happened as we moved through the 12 months that made up 2017, because it really was a year of two halves. And you see at the beginning of the year, we were looking at price growth, as I said, peaking out above 30% on a year-over-year basis. And then obviously as we moved through the year, especially after the introduction of the Fair Housing Plan, we saw a pretty steady drop-off in terms of annualized growth, especially when we got to the end of the fourth quarter, where we saw some periods where price was flat to even down a little bit in November compared to the previous year. And we can see the reason why. This red line is just taking into account the relationship between sales and active listings. Obviously, if the ratio of sales to listings increases, you say market conditions are tightening, and we'd expect to see tighter market conditions. So we see that at the end of 2016 and beginning of 2017, that line was very high. That red line was very high from a historic perspective, and it's no surprise that when you look at year-over-year growth in pricing, it was also high from an historic perspective. And of course, the opposite was true as we saw market conditions balance out later in the year. But I will point out that we did start to see a bit of a dichotomy or discrepancy arise as we moved through the last quarter of the year, where we actually started to see market conditions level off a little bit, but we saw sort of price growth maybe move a little bit off that trend that we've seen it fall over the last couple of decades. And so that suggests to me that we're still sort of shaking out some of the policy impact. And in all likelihood, if we see market conditions remain where they are, as we move through the second half of 2018, we'll probably see price growth normalize a little bit up from where it is now. But more on that later. Just the final slide before I turn it back over to Sean, and that's the fact that, if you look at price on its own without sort of breaking it down in terms of type, you're not necessarily getting the full story. And we really did see sort of diverging trends as we moved through 2017 with, detached homes not being quite as in demand as they had been in previous years. We saw a little bit more slack in that segment of the marketplace versus condominium apartments on the other end of the pricing spectrum, where market conditions remain still extremely tight, to the point where we continue to see, double-digit rates of price growth for the MLS Home Price Index for condominium apartments versus a more moderate pace of growth for detached homes. So I'll turn it back over to Sean. He can give you a little bit more sense of some of the consumer trends that we saw that aren't captured on a transactional basis in our system.
Yeah, so what do these buyers look like? Well, we know from the survey of recent buyers that 32% of them preferred new homes. That was up 2 points. That's not a significant difference, but most 68% bought resale homes, and they gave me a new clicker, so let's test it out. Oh yeah, okay, great. Got my mojo back. In terms of the type of home that they've purchased, fully one half of the homes purchased by these buyers were detached homes. That was very stable compared to last year. 15% semi-detached. Town and row homes, 13%. That was down 5 points from last year. And the proportion who bought condos, 22%, was up 3 points. So we saw a slight decline in town row homes and moving into more condos. In terms of the down payment that they used, one of the things that you might speculate as home prices rise, that down payment percentages would decline. But that's actually not what we're seeing here. I think most people are able to use some equity in their home to purchase their next home. And even among first-time buyers, we know that the average down payment is actually over 20%, in the low 20s. So year over year, we're seeing very stable proportions, where most people are in that 20 to 30% sort of sweet spot of down payment vis-a-vis the overall price of the home. And if we look at the average down payment between the fall of 2016 and the fall of 2017, it's stable at an average of 29%. So despite some volatility in the market and fluctuations in the market, it's even Steven for down payment percentages. Where are people getting their down payments? Among recent home buyers, it's a variety of sources. 31% said they had some savings that was outside of an RSP. For 15%, it was savings within an RSP. Obviously, that's significantly higher among people who purchased their first home, taking advantage of some of those benefits. 14% of the down payment was from family and friends, gifts, maybe could have been an inheritance or a gift from parents. 23% of that down payment was equity from a current home, and 16% said that 16% of the down payment was from some other source. In terms of the financing that they're using on their mortgages, again, despite the fact that we're seeing interest rates moving higher, the preference is for fixed rates. And I always find it a little bit interesting because I think over the long term, you're slightly better off using variable rates, but I think people like predictability, and so they still favor fixed rate closed mortgages. At 65%, that's only up 1 point, and there's very little differentiation between the 416 and the 905. In terms of the rates that people are getting on their mortgages, most people, again, in that sweet spot of somewhere between 2, 3, 4%. If we look at the average and how that has changed in the last year, in the fall of 2016, they said the average rate that they either got a mortgage or renewed at was 4.1%. In 2017, it's actually 3.6, 3.7%, and among recent home buyers, 3.6%. Now, I would have expected that in an environment of rising interest rates, that this average would have increased as well, but in fact, it looks like it's gone down a little bit. Jason, help me make sense of that.
Yeah, I think there's probably three things really to consider. Number one, just the weighting of sales that we saw last year, in the sense that the bulk of the transactions we saw were more heavily weighted to the first 4 months of the year, and that's certainly where we were seeing lower rates than what we ended the year off with. Number two, as prices are rising, people may have been looking, at other mortgage products that help them from that affordability perspective. And then obviously built in there too is there is the confidence interval on the reporting from one year to the next as well.
84% of home buyers say that they're confident that they could continue to be able to afford their mortgage even if rates went up by 2%, 2 points. And so we know then that there's some resiliency in the market. I mean, there's a lot of speculation as rates go up, given that they've been so low for so long, and it's a bit of an anomaly, that it may impact a lot of home buyers, and we're going to see a lot of people losing their homes as rates go up. And this suggests that that's not really the case. Only 3% of homeowners say that if rates went up by 2 percentage points, that they're not at all confident that they'd be able to afford their mortgage payments, that they'd be in trouble. The vast majority of people are very confident or somewhat confident, with some rejigging of their finances. Given the new stress testing requirements, we also posed a question to people and said, well, if you had to qualify for a mortgage at 2 percentage points higher than the rate at which you currently qualified, do you think you'd qualify at that higher threshold? And the vast majority of people say, yeah, 79%, yeah, I'd still qualify even if I had to reach that higher threshold. By comparison, 21% say they can't. So, does the stress test have an impact? For most people, no. But for 1 in 5, they're not convinced that they would still be able to qualify for a mortgage. So I think there is some impact there in the new stress testing, probably particularly for first-time home buyers.
I think just a final thought on that too, in the sense that you saw 84% of people saying that they could handle the additional costs brought on or payments brought on by 2 percentage points of additional costs, but at the same time, if you're looking at the qualification, those numbers are a little bit different. And I think that gets back to the point, and we've seen this in other, when we've seen other changes to mortgage lending guidelines, is that sometimes the average household in the GTA isn't given enough credit to sort of handle their balance sheet, because I think there is a lot of flexibility on the part of households that they could manage that additional increase, but then when you look at it from a pure qualification perspective, that number changes a little bit.
And I think given that interest rates have been so low for so long, there's been a lot of attention about rising interest rates and the impact of interest rates, and I think a focus on among banks and realtors to help people really understand what the impact of rising interest rates are on their home. And despite some of the fear that's out there, most people, I think, have a considered approach and said, no, I can work that into my finances.
Right. So, and I think that's a nice way to sort of segue too from what we saw in 2017 into what we expect to see in 2018, because I think that's going to really come to the fore. I think on the one hand, and I'll talk about this a little bit more when we get to the TREB MLS data, but I think you're going to start to see some of the psychological impacts of the Fair Housing Plan start to wane. But at the same time, that's going to be up against now the new impact of the OSFI stress test guidelines, along with a generally increasing cost of borrowing as well. But I thought we'd reverse the flow this time, Jean, and let you go through what you found in terms of consumer intentions, and then we could talk about that in terms of the MLS statistics.
Sure. Thanks, Jason.